Hello, and welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today is October 13th, 2025, and we have to talk about the absolute pandemonium we saw in the Bitcoin market late last week. It was one of the largest single-day liquidations in crypto history, and we're here to break down what happened, why it happened, and what the charts are telling us now. First, let's cover the news that acted as the catalyst for this massive sell-off. The primary trigger was the shocking announcement from U.S. President Donald Trump regarding a new 100% tariff on Chinese imports set to begin November 1st. This was a dramatic escalation in the U.S.-China trade war, and it hit the markets when they were most vulnerable, after the close of traditional stock exchanges on Friday. The crypto market, which trades 24/7, took the full force of the panic, triggering a cascade of liquidations. Reports indicate that over $19 billion in leveraged positions were wiped out in just 24 hours, with Bitcoin plunging from recent all-time highs above $126,000. Now, let's pull up the charts and see how this historic event has shaped the price action. Here on the daily chart, we can see the bigger picture leading up to the crash. Bitcoin had an incredible run, making a new all-time high just last week on October 6th, tapping the $126,296 level. The price action was bullish, with steady inflows into ETFs fueling the rally. But then we see this colossal red candle on October 10th, representing the flash crash. The price opened the day around $121,760 and plummeted to a low of $103,310 before closing at $113,080. That's a range of over $18,000 in a single day, a brutal move that erased weeks of gains in a matter of hours. Notice the massive spike in volume on that day, confirming the intense selling pressure and liquidations we saw in the news. The candle on October 11th showed continued weakness, pushing down towards the $109,000 level. However, the candle for October 12th shows a very strong bullish response. Price bounced hard from the sub-$110K region and closed strong above $115,000. This strong rejection of lower prices suggests that large players or institutions may have seen the dip as a significant buying opportunity. To really appreciate the speed and violence of this move, let's zoom into the hourly chart, focusing on the crash itself. I'm filtering the chart from October 10th through the 11th. Here you can see the price was trading calmly around $122,000 before the news broke. Then, in a single hour, we see a plunge of several $1,000s, followed by consecutive, brutal red candles as leveraged long positions were forcibly closed. The price cascaded downwards, finding a temporary bottom around the $103,300 level. The sheer velocity of this drop is what defines it as a flash crash, driven by programmatic selling and cascading liquidations. After hitting the lows, we can see the volatility remained high, but a floor started to form around the $109,000 to $110,000 level over the next several hours. This level has now become a critical short-term support area to watch. Switching to the 15-minute chart for that same period shows the chaos in even greater detail. You can see the exact 15-minute candle where the bulk of the damage was done, dropping thousands of dollars in a flash. This is a clear illustration of a market being completely reset by forced selling. The bounces were sharp but were met with more selling pressure until the market finally found its footing hours later. This granular view helps traders understand where liquidity was pulled and where buyers finally stepped in with conviction. Now, let's go back to the hourly chart and look at the current situation. After the strong bounce we saw on October 12th, the price is now consolidating. We appear to be in a range between the key support around $110,000 and immediate resistance near $116,000. The $110,000 level is particularly significant as news reports indicate this is where the daily chart is retesting a golden cross pattern, which is a historically bullish long-term signal. Holding this level is paramount for the bulls in the short term. A major resistance level to watch above us is the $119,500 to $121,700 zone. This area represents the price level right before the crash and the open of that massive daily red candle. Reclaiming this zone would be a powerful statement of strength and would likely invalidate the bearish momentum from the crash. So, where do we go from here? Let's outline the bullish and bearish cases. The bullish case is that this was a healthy, albeit brutal, leverage reset. With over-leveraged positions wiped out, the market can now continue its uptrend on a more solid foundation. The strong bounce from the lows and the defense of the $110,000 support level reinforce this idea. If Bitcoin can hold this support and break above the immediate resistance around $116,000, the next target would be to reclaim that pre-crash zone around $120,000. Some analysts are even looking towards targets of $130,000 if this structure holds. Furthermore, reports of whale wallets accumulating during this dip provide another reason for long-term optimism. On the other hand, the bearish case is centered on the severe macroeconomic uncertainty. A full-blown trade war creates a risk-off environment that can negatively impact assets like Bitcoin in the short term. If the critical support at $110,000 fails to hold, we could see a swift move down to retest the crash lows around $103,000. A break below that would open the door to the psychologically important $100,000 level and potentially even lower. Traders should be cautious, as the market is still processing this major geopolitical shock. Another key event to watch is the CPI print coming up on October 15th, which is sure to bring another wave of volatility. To summarize, the key price levels to watch are critical. Support is firmly established at the $110,000 level, followed by the crash low around $103,000 and the major psychological level of $100,000. Resistance is at the current consolidation high around $116,000, and then the major hurdle at the $119,500 to $121,700 zone. So for our unbiased predictions, I'd place a 60% probability on a scenario where Bitcoin consolidates above $110,000 and slowly grinds its way back up to test the $120,000 resistance zone. This likelihood increases if geopolitical tensions show signs of easing or if the upcoming CPI data is favorable for risk assets. Conversely, there's about a 40% probability of a bearish scenario where the $110,000 support fails. This would likely be triggered by more negative trade war headlines or a poor inflation report, leading to a retest of the $103,000 lows. The key thing to watch right now is whether buyers can continue to defend the $110,000 support zone with conviction. Thank you for joining us today on Explain the Charts. Remember to watch for the CPI data on October 15th. Finally, a quick disclaimer. This video is for informational purposes only and is not financial advice. You should always conduct your own research and consult with a professional before making any investment decisions. Please like, subscribe, and hit the notification bell for more in-depth chart analysis. We'll see you in the next video.